I welcome you all back to our channel. Thank you for taking some time out of your day to be here with me. I'm Patrick Zimmerman, and today we'll be discussing how to achieve 100% yearly returns investing in the ARK Disruptive Technology ETFs. If you're not exactly sure what an Exchange Traded Fund ETF is, you can check out my video on 5 ETFs to retire successfully. I'll throw it up on the screen and link it in the description. There's a nice overview there if you need help with some of the terminology before we jump into this video. If you stick around till the end of the video, we'll be comparing all 5 ARK funds against the 1-year chart of SPY, which is essentially the S&P 500 ETF. And we'll also be diving into their holdings a little bit, and I'll show you why it may not be beneficial to own all 5 of the ARK funds, even though their yearly returns are outrageously high. Don't forget to like this video and subscribe to the channel if you'd like to see other videos like this. Also, leave me a comment down below letting me know which ARK fund is your favorite. I'll be telling you mine a little bit later in the video.
Skies are clearing up.
Before we jump into the 5 different funds themselves, I want to talk a little bit about ARK as a company. Their main goal is investing in the future. These are industries which they consider to be disruptive innovation, and pretty much all of them are technology based. Now, just because these companies are mainly technology companies, it doesn't mean they only consist of companies from the technology sector. 2 of the ETFs we'll be talking about later revolve around healthcare and financial sectors. It's also important to note that ARK does a really good job in researching the holdings of their funds, which are essentially all growth stocks. And I believe this is one of the largest reasons why a couple of them have above 100% yearly return on investment. The first fund we'll be looking at is ARK's Disruptive Innovation Fund, stock ticker ARKK. ARKK is their largest fund with $8.9 billion in net assets and a typical holding of between 35 and 55 different stocks. The weighted average market cap here is $76.3 billion, and they're charging an expense ratio of 0.75%. Now, the reason these expense ratios are a little bit higher than some other ETFs you might be invested into or are looking at is because although these are considered exchange-traded funds, they are actively managed. That means for each fund, there's a whole management team doing research and constantly monitoring and updating the portfolio, whether it be new stocks to take in or out or ways to adjust the holdings for the safest diversification. I myself generally like to invest into ETFs which have an expense ratio below 0.1%, but I'll make an exception for these funds because their yearly returns are so high and your money is growing at a much faster rate than that of an S&P 500 ETF, which we will look at the end of the video. So ARK's Disruptive Innovation ETF, ARKK, concerns themselves with technology advancements in scientific research relating to DNA technologies, industrial innovation, energy, automation and manufacturing, the increased use of shared technology, infrastructure and services, and technologies that make financial services more efficient. ARKK is essentially ARK's largest active ETF, and it really is a conglomerate of the biggest holdings from all the other ETFs we're going to look at later in the video. Here is the 1-year chart. They are currently trading at $107.42. And the NAV, or net asset value, is $107.35. So they're doing a pretty good job at keeping those two in line. The net asset value is essentially the intrinsic value of the holdings against the market price, which is what people are willing to trade it for. Here are the numbers in regard to ARKK's performance. Over the past year, they are up 115%. Which is just really amazing, and that's not really a number that you expect to see in an ETF, but it really touches on how great the management team is doing, not only with selecting which stocks to put into the portfolio, but also that they're staying on top of things while actively managing it throughout the year. Here are the top 10 holdings for ARKK. You can see Tesla at the top, a company which concerns themselves with the future of electric vehicles at 10.16%. Roku's up there, an entertainment and streaming service, which is at 6.7%. Square Inc. at 5.85% is in the financial sector. CRISPR Therapeutics, Teladoc, these are from the healthcare sectors at 5.5% and 4.03% respectively. We also have Zillow Group at 3.15%, which is a real estate app. Looking at these top 10 holdings, it really exemplifies that ARKK isn't necessarily focused on one specific type of disruptive technology, but that they have their foot in the door of many different technological facets of the future. As we continue on in the video, you'll see the later ARK funds that we look at are kind of more narrow in their approach, and they're only chasing after specific technological advances. The next ARK fund we'll be looking at is ARK's Autonomous Technology and Robotics ETF, stock ticker ARKQ. ARKQ holds $633 million in net assets, typically ranging between 30 and 50 holdings. Their weighted average market cap is just below 162 billion, and that expense ratio is the same at 0.75%. So you can tell by those net assets and the weighted average market cap that this fund is invested into a bit smaller of companies, maybe not some companies as large as that of ARKK relatively, but that's because they're not concerning themselves with all the disruptive technologies. They're keyed in on future technologies such as autonomous transportation, robotics and automation, 3D printing, energy storage, and even space exploration. Here is the one-year chart for ARKQ. They're trading at $67.36, and that net asset value is $67.34. Their performance numbers may not be as high as that of ARKK, but an 81% annual return is still something that anyone will be proud of and is really amazing in itself. And here are the top 10 holdings. Tesla on the top, of course, with 11.88%. Another company which concerns themselves with electric vehicles here is Workhorse Group on the bottom at 3.15%. They also have companies like Alphabet, which, if you didn't know, owns Google. They're weighted at 4.25%. And another company here which you may not know about, Proto Labs, at 3.52%, is a 3D printing company. The third fund we'll be discussing today is ARKW. This is ARK's next generation internet ETF. They hold $2.4 billion in net assets, typically ranged between 35 and 50 holdings, and the weighted average market cap is just below $167 billion. Their expense ratio is a bit higher at 0.76%. But again, nothing to worry about for now with those insane returns they're offering each year. ARK's next generation internet ETF mainly consists of companies which focus on cloud computing and cybersecurity, e-commerce, big data and artificial intelligence, mobile technologies, social platforms, and blockchain and peer-to-peer systems. They are currently trading at $129 with a net asset value of $128.96, and their one-year returns are just above 123%, which I believe is the highest on our list today. Even if you were to hold this fund for just 3 months, you would still grow your capital by 28%. Obviously, you can see that the one-year returns are about 100% more, so it probably won't be advantageous for you to sell after 3 months, but 28% growth over 3 months is still very, very good. Here are the top 10 holdings for ARKW. Tesla at the top again, 9.9%. We also see Roku and Square again at 7.69 and 5.52% respectively. Teladoc Health is up there, 3.43%. One that we haven't seen before, Spotify Technologies, 3.3%. And there are also social media companies such as Pinterest, which is 2.66% of the weighting. Now, I think ARKW is probably my favorite fund on the list, not solely because the 1-year returns are the highest, but because they focus a lot on the e-commerce business, which I think will grow exponentially in the years to come. Before we get into the last two actively managed ARK funds, I want to remind you guys to subscribe to the channel and hit that notification bell. Like the video if you found it helpful as of yet. Let's shoot for 15 likes on this video. If we get that, I'll release a video on how you can beat the yearly returns of the ARK ETFs by cutting out that expense ratio. The next fund we'll be talking about is ARKG, which is ARK's Genomic Revolution ETF. They hold $2.3 billion in net assets between 30 and 50 holdings. The weighted average market cap is $7.2 billion, and that expense ratio is 0.75%. The Genomic Revolution ETF, ARKG, mainly focuses on technologies such as CRISPR, targeted therapeutics, bioinformatics, molecular diagnostics, stem cells, and agricultural biology. This is the healthcare fund that I was talking about earlier in the video, as much of their focus points towards companies which attempt to improve the life of humans through technology. Here is the 1-year chart for ARKG. They are currently trading at $77.06 with a net asset value of $76.97. The annual performance for ARKG is just above 122%. If you believe, as I do, that healthcare improvements are about to take leaps and bounds in the future because of new technological advances, I believe that ARKG is a great place to put your money. That share price is still sub $80, which really isn't that expensive to get into, and they are offering the second highest yearly returns on the list at 122%. Here are the top 10 holdings for ARKG. This is the first ARK fund which does not hold Tesla, as they are focused on improvements in healthcare through technological advances, but they do hold CRISPR Therapeutics at 8.57%, as well as Twist Bioscience Corp at 5.99%. If you currently hold another ARK fund in your portfolio, ARKG also might be a beneficial fund to hold because you don't see a lot of repeating in the top 10 holdings. As I've said before, at the end of the video, we'll be discussing why holding funds which are too similar can be dangerous for your annual returns, because although they hold multiple stocks, your portfolio may not properly be diversified. The last ARK fund we'll be talking about today is ARKF, which concerns themselves with Finntech revolution. This is the fund which mainly deals with companies trying to make technological advances in the financial sector. ARKF's net assets are $674 million, with a range of 35 to 55 holdings. That weighted average market cap is just above $230 billion, and their expense ratio, like the others, is 0.75%. Some of the companies which ARKF likes to focus on deal with transaction innovations, blockchain technology, risk transformation, frictionless funding platforms, customer-facing platforms, and new intermediaries. Here is the 1-year chart for ARKF. They're currently trading at $45.42 with a net asset value of $45.33. Their 1-year performance is currently up 86.88%, which are incredible returns for only costing you $45 a share. And the top 10 holdings here are companies like Square at 11%, Pinterest 4.66%, Zillow's up there, 4.19%, and they even own a little bit of PayPal at 3.49% of the fund. Another great holding here is Alibaba Group, which is an ADR because it's a Chinese company, but it's a lot like Amazon, and it's being weighted at 3.15%. Here are the annual returns of all 5 of the funds we've discussed against that of the S&P 500. I know there's a lot going on here, but you can see the stock tickers in the top left corner. ARKK in blue, ARKW in purple, ARKF in light blue, ARKG in pink, ARKQ is orange, and the S&P 500 is in that dark red or brown, if you will. So you can see that up until now, for the past year, the S&P 500 is up about 15%. And you can see just how well each of the funds has performed. Despite their ups and downs, they've all grown at least 5 times more than that of the SPY ETF. Now, I want to touch on why it could be dangerous to hold multiple of these funds. I have taken the top 10 holdings from the 3 funds ARKK, ARKQ, and ARKW. ARKG and ARKF are a little bit different because, for the most part, they have different top 10 holdings than these 3 funds. So maybe if you want to pair one of the funds up with that, it would be perfectly okay. But especially ARKK and ARKW, the ARK Innovation Fund and the ARK Next Generation Internet Fund have a lot of repeated holdings, so it might be dangerous to hold both of these at substantial levels in your portfolio. You can see on the pie charts and the color-coded tables the holdings of the shared companies in each fund. The reason this is dangerous is because, say you were to hold all 3 of these funds and just these 3 funds in your portfolio. Because of the weighting of each ETF in regard to Tesla, for example, your portfolio would consist of 30% of Tesla. Even though you don't own any actual Tesla shares, you are invested into each of these funds, which each have about a 10% weighting of Tesla shares. That's how we get that 30% of your portfolio. So if Tesla was to have a terrible few months and the share price was to drop dramatically, that could vastly cut into the returns you're making. Now, I'm not saying Tesla's going to drop. Obviously, they are a company which has a vast amount of room to continue to grow, but you do need risk management and you need to be properly diversified in case something like that does happen. None of us can tell what the future will hold, and it's important that you hedge your risk with ETFs and companies from different sectors which you are not heavily invested into. Thank you all who have made it this far into the video. I hope you learned some valuable information and will consider investing into these exchange traded funds as their returns and popularity have just skyrocketed. I want you to remember to like and share the video if you found this information helpful. Hit that subscribe button and turn the notifications on for similar content to this in the future. And leave me a comment down below letting me know which ARK funds you currently hold or which one you would like to purchase after discussing them today. As always, I'm Patrick Zimmerman. Thank you for your time and have a nice day.